We should make an AI video of Ben Bernanke in the cockpit of an A-10 Warthog, and then he turns on the General Dynamics 30 millimeter auto cannon and just like
dollars,
spewing money everywhere.
Dollar rolls, just 30 millimeter dollar rolls. Oh man,
I can't. It's so hard to imagine that this thing just keeps going. Every high shocks me. Ladies and gentlemen, welcome to another episode of the Bullion Standard Podcast. Charlie, good afternoon. How are you doing today?
Brother, I'm well, thank you. Happy holidays. We're coming up into the holiday season. I hope everyone has a lot of great experiences. And if you don't have a lot of great experiences for the holidays, I hope you have a lot of good memory of a lot of great experiences for the holidays.
I want to start us off by talking about the fact that it's getting really interesting out there. I am just going to say ad nauseum until I am blue in the face that this is a paradigm shift year for precious metals, Charlie. Inflation has been ticking up this year, particularly since April when it bottomed. And we're, I think, at 3% today at the CPI print last month. You would think that the Fed would be keeping interest rates the same or maybe even hiking them. I've read on Twitter that some people are saying the Fed needs to do an emergency 50 basis points rate hike. I think that would be the biggest death blow to the economy ever conceived. The system is just getting too clogged up with debt, with deficits. We're well into this interest rate lowering
with regulations.
Cycle. Yeah. And
we're going to deregulate our banking system a bit. We're having some commentary coming from our Secretary Scott Bessent. We've got some of our financial leaders in the country. They're changing their narrative more towards, deregulating the banking system and allowing for more liquidity to flow into the banking system, which is needed to get the GDP up, right? How are we gonna solve the deficit and the debt? You got to grow out of it. That's the only option right now. And so, what do you need to grow? The liquidity. We need a little liquidity. What does a little liquidity mean? Well, a little liquidity means potentially what you just spoke to is a little more inflation in 26 and 27.
There's an interesting post I read where somebody said at the beginning of the year, Trump is going to run it hot.
Yeah.
Trump's going to run it hot.
Yeah. There's no other choice. I mean, there's really no other choice. You can't save your way out of this right now. Like we already tried doing that. The bond market revolted the beginning of the year. It's impossible.
I think this is a perfect segue into some of the stuff you were talking about off camera that you'd like to share today. Inflation is probably going up. I sound like a broken clock. I mean, we've said
Kyle,
this so many times now.
Brother, is inflation going up?
Inflation is going up.
Okay. How much?
It's been a noticeable uptrend. I think it bottomed in April of this year.
So here's one thing that I've realized over the years. We've got a lot of people that have a lot of different opinions. Most people are right. It's just that their timing's off. We're going to have inflation. We're going to have deflation. We're right about that. It's just that our timing may be off at times. Okay, so we want to talk about all the stuff again, but we also want to talk about answering a question that someone wrote in our last video in the comments section. So we'll get to that. We're going to talk about some more current events, what's happening. I want to talk about the Trump and Mamdani conversation. Absolutely fascinating. I watched the interview from start to finish. It's, in my opinion, it's a very critical moment in time. Like I'm just saying right now, what happened with the Trump and Mondami conversation is absolutely going to be a catalyst for stability. Let's just go into it right now. I don't know everything there is to know about it. I'm not like following politics. I just kind of see some things here and there. But what I think I know is that we have a lot of contention. There was this mayoral race in New York, and we've got two different political ideologies at play. And these guys apparently are just ripping each other apart. And I saw a few things and I'm like, oh man, this is rough. Like, this is going to be like civil war. And then these guys go in and talk to each other. And this is what I heard. Hey, we're not so different after all. We disagree on some stuff, but we also agree on some things that are good for humanity. Low crime and prosperity. And so here's two people that for a long time we've been in this political divide. And I'm going to say until now, I'm going to say this is the catalyst point when we have two leaders in the American politic that come together on the heels of tearing each other apart, and they agree on some things, and they can be in disagreement. I mean, Trump's like patting the guy on the arm, and he's shaking his hand and patting his hand, and he's like, they're buddies. What a great example. You can be in disagreements with someone, and you don't have to go to war. Hey, I think, and I don't know all there is to know about it, but I'm hopeful, and it's a message of hope that those two guys got together. And, people will probably say, yeah, but it's politics and there's backdoor deals happening, all this stuff. Great, no problem. Like, I guess, that stuff's going to happen. But here's an example that we can hold on to, a message of hope. So it's possible, maybe even likely, that we're going to have some really great growth in 26 and 27. Now, we're also going to have some inflation. So is growth going to outpace inflation, or is inflation going to outpace growth? That's what the question looks like that we need to be focusing on right now.
Let's talk about that for a moment. Could growth outpace inflation? I'm going to say no. Here's why.
Okay, Chicken Little.
Yeah.
You're not wrong. I'm saying your timing may just be off. It might not be 26 or 27. We're going to find out.
Yeah, of course, the interruption to that would be some kind of deflationary bust where we have a confidence event, a liquidity event, a crisis event around
we're heading there.
How people perceive the markets today, especially with this AI bubble. It takes 1.3 units of debt to create 1 unit of GDP, Charlie. This is
in our public sector.
Yes.
Okay, so
that's GDP of the United States. That's the whole thing, not just the.
Are you talking about government spending?
I'm talking about gross domestic product of the United States. So you have GDP, takes 1.3 units of debt to create 1 unit of GDP. In other words, the debt to GDP ratio is 130%. This is going to be very inflationary.
That's under a fiscal dominance regime where the government's spending money, and with that government inefficiency, you're going to be in a negative debt to GDP ratio. Now, if you put that into the private sector, maybe we'll call it the capitalist economy, where people can transact and make immediate decisions in their transactions and their choices, you might actually get a little more GDP than debt. We're going to have more private sector in control of more of the money. And so we're going to get a boost in GDP for the debt to GDP the debt to GDP ratio will go down. Will it go down to 80%?
I think that's very unlikely to happen. I don't think there's any going back to what's happened in the past. Here's why. Once this money gets issued, once these currency units get created, they don't go away. They just kind of fester in the system and marinate. And then ultimately, money creation begets money creation, and you just have to continually pump and expand. That is literally the nature of number one, central banking, and number two, having no connection to a form of price controlled money, like when gold was price fixed. So it's something where, as long as politicians, like to have control, there will always be money creation and money printing, no matter how hard any president comes out at the onset of their term and says, we're going to Doge this thing up. We're going to Department of Government Efficiency this thing up. No way. And Charlie, since we've recorded our last episode, the Department of Government Efficiency, I think it's been disbanded. Have you read about this?
I did. Yeah, it's done. It didn't work. It could have been a like ploy or something. It could have been just this manufactured thing. We may have known that it wasn't going to work. When I say we, maybe our politicians, they may have known it wasn't going to work. But obviously, it was a uncovering of a lot of fraud. So, can we? Because I noticed we've just gotten into our conversation. Can we ask the question that one of our viewers put in the comments?
Yeah, let's go.
Yeah, let's do this. So
who asked the question first? I mean,
okay,
it's pretty obvious.
we've got at John Miller 3949. John, thank you so much. We really appreciate you for the question. It's very thoughtful. And the question is, what would happen if the U.S. started buying gold like central banks in other countries? Why don't we? And then move to a gold standard. What would happen to the world economy and the U.S. dollar?
Well, the U.S. has supposedly, Charlie, the world's largest stockpile of gold. Although there hasn't been an official audit, I think that's something that kind of got swept under the rug. So my answer would be, I think it's because the U.S. already purports to have the world's largest share of gold. I don't know how many metric tons it is, but if we had a chart, we could see that it's way above any other country in the world. It's a lot of gold, ton of gold.
Maybe we are buying a bunch of gold right now. Maybe we don't know that we're buying a whole bunch of gold right now in the U.S.
Yeah.
I mean, we know that there's a lot of people buying a lot of gold because, I mean, we're just growing tremendously right now. So it's happening. Let's also distinguish that there's a pro and a con to everything, right? So central banking, there's pros to central banking. There's cons to central banking. Gold standard, there's pros to gold standard. There's cons to gold standard. There is no one decision that's going to solve everyone's problems. When we didn't have central banking that could just bazooka money, we had bank failures left and right. We also had a whole bunch of, when we didn't have central banks, we had all the states created their own, there were banks created separately in all the different states, and those banks issued their own notes. So there was just all this these different monies in the United States.
Yep.
So one of
each bank would actually issue its own paper currency, and this was really common. And so, a particular issue that comes to mind for me is, I think in the year 1928 or 29, all these little banks across the nation issued their own $20 bill, $10 bill, $5 bill. I think it was called a brown seal. And it was, the bank's name was printed on the bill. It was national currency.
Okay, I'm gonna give you 10 common reasons why we would want to replace central banking with with the gold standard. Prevent inflation and devaluation of the currency. Prevent excessive money printing. I mean, this is stuff we already know. To increase fiscal discipline. To restore trust and stability in money. To prevent asset bubbles created by low interest rates. To reduce income inequality linked to monetary policy. So asset inflation, stocks, bonds, and real estate are disproportionately it benefits the wealthy because they own it. So hard money will reduce wealth concentration created by quantitative easing. So I mean, we have a wealth disparity right now. So some of the cons are inequality existed under the gold standard too. So the deflation under gold can hurt workers and debtors far more than creditors. So we've got the pros and cons to inflation and deflation with a gold standard and with central banking. So to limit government and central bank power, obviously, to strengthen long-term economic planning. We've talked about that a lot. Short-term sacrifice, long-term gain. You want to steal from the future, have your short-term gain and pay it off later, plus the accrued interest, plus the longer you push it out, the more interest is getting accrued on the interest that you're not paying. So we had the Great Depression, right? Funny money. 1970s inflation, funny money. 2008 financial crisis, regulation, funny money. The COVID era, inflation, bazooka, like giant bazooka. We had massive bazookas of money right into our consumer bank accounts.
It was helicopter money redefined.
There we go, helicopter money. It was like helicopter money. What's the A10 Warthog machine gun? What's the name of that gun?
The General Dynamics autocannon.
Yeah, it's just the
30 millimeter autocannon.
Yeah, like 1,000 rounds a minute or something like that. That's the kind of money that was getting deployed. Just massive amounts of money. We
should make an AI video of Ben Bernanke in the cockpit of an A10 Warthog, and then he turns on the General Dynamics 30 millimeter autocannon and just like
dollars,
spewing money everywhere.
Dollar rolls, just 30 millimeter dollar rolls. Oh man.
I think the policy response to what will happen in the next liquidity crunch will be of such enormity. Each printing cycle going back to really since we've been disconnected from gold, each slug of liquidity for each subsequent event has to be larger and larger and larger.
Mm-hmm.
The 90s were larger than the 80s. The policy response in the 2008 financial crisis was larger. I'm sorry. The policy response during COVID relative to the policy response to the 2008 financial crisis was larger. I don't know the specific number that was counterfeited in 2008, but I suspect it's somewhere around $1 trillion, somewhere around there. And then COVID, it was several trillions of dollars. Like, I can't think of the exact number, Charlie. It's like $6 or $7 trillion was printed out of thin air in 2020, 21, 22. So what could the size of the next event be? And we talked about on another episode, we would never want gold to go to 20,000, but ultimately it's going to, if this current system lasts and continues.
We want it to go to 20,000 overnight.
I want to have Rick Rule on this show, Charlie, and I want to really ask him this question. Rick talks about the fact that we don't want the price of gold to go up. He's not the only one who's talked about it. There's a lot of people who'd say that same thing. So,
sure.
But he is a good voice for this question. I want to ask Rick, since he was alive in the 1970s participating in these markets, what was the standard of living like going from 35 to 850? That's a big increase. That's over a 20x, 20 bagger in just the raw
Kyle, people were
price.
buying things that they didn't need because they were afraid that the price was going up. And if they didn't buy it now and they need it next year, Kyle, in Weimar, Germany, during the great hyperinflation, people would demand their paychecks halfway through the day because by the end of the day, the money had collapsed so much. So
that's the same thing in Venezuela with Nicolas Maduro, who was a bus driver from Cuba, and now he's the socialist dictator of Venezuela. But let me back up a bit on this question because it's really important.
Okay.
What would be the net result of gold doing a 20 bagger from its base of this most recent cycle? I think the gold bull market...
Over what period of time?
9-year period, just like in the 1970s.
Okay.
So let's do this. I think the bull market in gold started in January 2019. That was the first time we had a real, technical breakout right after the worst Christmas since the Great Depression, December 2018. But let's use the bottom price. So it was right between December 2015, January 2016. That's when gold bottomed after coming off its 2011 high.
You're going to call 9 years for the termination point of the gold bull market?
Yeah. So what would be the
So what year will that be? 2029?
Yeah, let's call it 2029.
Okay. Isn't it interesting that Neil Howe predicts the catalyst for the transformative event in the fourth turning, and then the consequence of the rebuilding in the first turning to be in that 2030 period as well?
Yeah. And obviously gold blew off in the last few years of the bull market. There's a fun saying that says 90% of the gain is made in the last 10% of the move. Obviously, this could apply to commodities like gold and silver. They get speculative just like any other commodity, but it has a much different utility than coal. Gold does not have the same utility as coal or iron ore or nickel or neodymium. So here's the question to ask somebody from that decade. Charlie, could you imagine today if gold went from $1,000 to $20,000? Because that's basically what it did in 1971 to 1980. Like
over 10 years?
Yeah, what was there? Because in my mind, I think $20,000 gold, that's nuclear holocaust. But that happened already.
Well, you got to consider the boiling of the frog theory. Hey, everyone, how about 10% inflation next year? You want to vote for that? Nobody's voting for that. Nobody's okay with that. But if it's 2%, why does no one have a problem with 2% inflation? Kyle, why do people not care that our policymakers tell them, we're going to reach into your wallet and we're going to pull out every year, every single one of your bills, and we're going to clip 2% off? Nobody's getting their pitchforks and torches over that. Why is that? Because it's the boiling of the frog theory.
At what temperature does the frog go from a slow boil to a roiling boil? And at what temperature does the frog perish? And I say that in the context of going back to what I said at the beginning of this episode. It looks like we're going to have to run it hot. How hot until the damn thing dies?
Why hasn't the Fed come out and said what they likely know?
Are you going 3%? Is that where you're going? Is that
That's exactly what I'm going to
say? Is that what you're alluding to?
Why hasn't the Fed come out and said, hey, everybody, we're just joking. It's actually 3%, not 2%.
Yep.
3% might be too hot. If you're going to come out to the general public and say it's now 3 on the heels of 10 through COVID, 9 point whatever, the pitchforks and torches might come out. We don't know, but certainly 10 would. 10 would absolutely do it. Well, we would have a revolt of the public. Our public institutions would topple.
Well, it was 9.2, I think, in June 2022.
That was in response to a crisis that people were distracted by, rightfully so.
That's also the same time period where everything got absolutely decimated, starting in December 2021, lasting until about October 2022, while inflation was real hot and we were hiking interest rates. It was a bear market, if you recall. The S&P 500, the NASDAQ, gold, silver, everything kind of got whacked because interest rates, we were on the hiking cycle.
Let's talk about what Secretary Scott Bessent just said. Let's talk about what Fed Governor Steve Moran just said. I'm gonna read a couple of quotes here.
The floor is yours.
Here we go. Ready? The Fed. This is Mr. Bessent. The Fed has taken us into a new regime in what is called ample reserves regime, and it looks like that might be fraying a bit here in terms of whether the reserves are actually ample in the system. So he's questioning whether we have enough reserves. And also, you know, the Federal Reserve is an institution that is under political pressure right now too. So are we going to have institutional regime change in the Federal Reserve as a consequence of our destabilized natural cycle going through a fourth turning? Okay, so Steve Moran, federal governor Steve Moran, Dr. Steve Moran. At some point in the future, we'll go from a flat balance sheet to an expanding balance sheet because we need to purchase securities in order to maintain a minimum level of reserves in the system that banks need for the regulatory system. So he also said the minimum size of the Fed's balance sheet is ultimately set by regulatory framework. So how are we regulating our banks? So maybe that's part of the institutional change that we're seeing currently happen is we're easing the regulations on the bank. So I'll continue. So my hope is that we continue with bank deregulation that we've been doing, continue right-sizing the regulatory apparatus, maybe rethinking the regulatory apparatus. What's rethinking? I mean, that's a structural change. I mean, we're going to rethink, we're going to change. I mean, so what does that mean? A little fakey QE maybe? I mean, we're going to increase the velocity of money and we're going to have some inflation.
Have we had a soft landing, Charlie, or have we had a no landing? I don't think we've had a hard landing. Obviously not, given the fact that the stock market is at all-time highs. I think the NASDAQ is off like 10 or 15% at the time of this recording from its all-time high recently. But I would say we are in camp no landing. I mean that because we haven't truly returned to the 2% inflation target. And we're creeping back up in inflation. You know who Michael Burry is. He shorted the great financial crisis. He shorted the housing market.
Yeah, he's gotten some coverage in the press.
Yeah, have you seen that he just said, hey, I'm out, I'm closing this thing, see you later. It's just way beyond my wildest imagination. I just can't participate in this anymore. That's how out of control this is. That is a pretty good indicator of where we might be. And so I think to myself, could this stock market mega rally, could the S&P 500 go to 10,000, or are we going to have a crisis in confidence first? And if the answer to that question is it's just going to keep going up forever.
I have the answer. I have it. The answer is yes to all of it. It's just, is your timing going to be right?
I can't. It's so hard to imagine that this thing just keeps going. Every high shocks me. It's obviously a massive raging bubble. And now it's getting to the point where these big AI companies, it's like that scene from the Three Stooges.
Mm-hmm. We've seen the meme.
Let's reenact that scene. Hey, you owe me $10. Okay, here you go. Here's your $10. Oh, wait, hold on. You owe me $10. Well, here you go. Oh, you owe me $10. Oh, here you go. You owe me $10. Okay. Oh, remember 2 weeks ago that $10 you owe me? Okay, yep. Oh, hold on. You owe me that $10. Okay. We're all even now. That is the level of investment and interest happening at these really big, large AI companies. And from that point of view, I can't help but think, we're not going up anymore in this thing before the thing finally has a reset, before people finally realize, hey, are you guys ever going to make any money? I hear you need $200 billion in the next few years, but you're only going to make like a fraction of that.
I mean, geez, if tariffs are out, like I would definitely love to know and be out before tariffs. I would love to cash out. Like Michael Burry, if tariffs are out, Michael Burry made the right choice, right?
There's a hedge fund manager who I follow. I think he's very smart. And I've noticed that a few weeks ago. He goes, I'm just in treasuries. I'm out.
Yeah.
Like this, it's so beyond comprehension how much of a bubble this thing is.
Yeah.
I remember thinking in February 2020, we were in a bubble. And then the market had a crisis in confidence.
It had the A10 Warthog Gatling gun, bazooka gun of money directly injected into every aspect of the entire economy.
I think the tariff dividend might be a little bit of a front for the fact that the only way forward is to spin up that gun and just money bazookas.
So what happens if growth doesn't solve the debts and deficits?
How can growth solve the debts and deficits, Charlie? Logically think about this for a moment, if you will. So right now, if we want to have 1 unit of GDP, we have to create 1.3 units of debt in order to create that 1 unit of GDP. You can't grow out of that.
Okay.
If you want to go down sub 1-to-1 debt to GDP, get back to a positive number like we had in the 1970s.
Yeah, is that going to cause deflation? Is that a serious problem?
Yes.
Mm-hmm.
We need to have massive deflation.
So what happens?
What is the consequence of massive
Right.
deflation? Depression, severe recession, bad tasting medicine. Go ahead, open up. It's time to take this vile, evil
Your
tasting
deflationary medicine.
Yeah.
Yeah.
So I'll leave
okay,
you,
so we're going to continue down the path of we're not going to be able to grow our way out of this, right?
we can only issue more debt and keep doing this thing called kicking the can down the road.
And what you've been saying this entire conversation is we're going to have more inflation. So what do we do at that point? We have price controls. Like, we're not going to tolerate that. We're not going to tolerate these prices that are out of control. The people will get their pitchforks and their torches out, and they will demand it be fair, and rightfully so, because there is such a wealth disparity that it's like, this isn't right. Like, everyone's "it's not fair" context is going to be showing, and so what happens at that point? Well, price controls every time has resulted in
Fail?
shortages.
Yeah. You can't artificially manipulate a market without consequence.
Okay,
This
so
is the whole nature of the Fed.
So-
The Fed artificially manipulates through its balance sheet. What does it mean when the Fed's going to run off its balance sheet? Yeah, they're selling bonds into the market. They're lowering the price. They're increasing the yield. When the Fed does QE, it's creating price action in the bond market, driving the price of the bonds up. It's out there bidding up bonds with this freshly counterfeited money. What's that doing in the bond market? It's creating positive price action. Price of bonds goes up. Yield goes down. Everybody benefits. Assets go up. Real estate goes up.
real estate goes up. Can I get a 2.25% 50-year mortgage now?
I honestly, I
Will we ever see the 2 point whatever mortgage in our lifetime? What do you think?
in late 2020, I had a discussion with a realtor, and I said, "What is the lowest 30-year fixed you've done?" 1.5.
Oh man, someone must have bought down their rate.
Someone bought it down.
Wow.
I think it was a VA deal.
Can I get a 50-year 1 point? I will borrow. How can I borrow as much as I possibly can borrow? I will sell my soul to the devil to get 1.5 for as long as I can. I would never do that. But anyways, the bottom line is there's a wealth disparity. Why is there a wealth disparity? Because people that can go out and buy stuff can lock in long-term low rate interest in an inflationary environment where rents go up, price of goods go up, and wages go up. So after 10, 20 years, you're still paying on that fixed rate interest, but you're earning way more dollars nominally, and you've locked in that nominal amount for your loan.
I just want to say I want to go on this tangent right now, and I think it's really important because
Do it.
because it ties
Let's
into
go.
what we've been talking about pros and cons of a gold standard, pros and cons of a system that we're in today.
Federal Reserve banking system.
This context trail you talk about of it's not fair and wealth inequality.
This normal human reaction.
Yeah. Let's talk about how it was in a period of time where we are on a gold standard and money was fixed and we couldn't have this expansion of assets. That's the whole philosophy behind this
expansion of money supply.
Yeah, that's the whole philosophy behind this wealth inequality. Generally speaking, the wealthy and people who are well off for themselves own assets that are beneficiary of perpetual money creation because there's inflation. Everything gets inflated. All boats get raised with this rising tide.
Unless you don't own an asset, at which point you don't have a boat, at which point it doesn't get risen by the tide and you have to try and tread water outside of a boat.
So one of the benefits that I would say has been a consequence of, in a positive way, of going off the gold standard and having this, perpetually increasing money supply is maybe everybody's standard of living has increased. Would you agree with that?
Yeah, what's the term?
Compared to how it was in the 1930s. And a great way to measure this is just life expectancy, I guess. Everybody has a longer average age that they would live compared to how it was. We'll just use 1933 when we were off the gold standard. So everybody is a little bit better off today from a standard of living point of view in developed first world nations, of course.
Because we went off the gold standard, because we were able to juice the economy with money supply and feed the machine of innovation and create resolution to disease, to scarcity, to bank failures, to resets.
Right. So everybody's standard of living increased across the board. It's been so good for so long with that increased standard of living. Everybody's living this pretty nice life. It's like, it's first world standard of living, USA. I have access to all these cool things that would give me a lot of creature comfort in my life that didn't exist even 50 years ago. Now everybody starts to have this baseline expectation. You've said it best before. My air conditioning is a right. My hot shower is a right.
Oh, yeah. Hot showers. Absolutely. I put a note in my phone. Remember that a hot shower, however many years ago, regularly didn't exist.
Correct.
And have a little gratitude for a hot shower. We forget to have gratitude for a hot shower.
Now we're at this new floor of living standard in a world fueled by the perpetual money printer and not having any connection to a real form of money. Now this is where it gets kind of interesting. Those people who are at this new baseline start to go, yeah, this sucks. Where's my $1 billion? Where's my $10 million?
Well, that's a little extreme. We might be able to say something like, hey, I can only afford food and a roof over my head and childcare, and that's it.
So now that everybody has a new baseline standard of living, what happens when those people have that human context of it's not fair after they've been lifted up to this new standard of living? That's the whole philosophy of what I wanted to
Let me say one more thing,
to.
And then we're going to wrap this up. This is really important to understand. Because we'll always say yes when someone asks if you would like a little bit more. If we have a standard of living that is like 95% awesome, it's so good. The odds of making a change are not that your standard of living will go from 95 to 96. It is so highly unlikely that it will go from 95 to 96% and get that 1%. It is way more likely that if you make a change structurally in your life or in our systems across the board, that we will go from 95% down to 80 because we made one little change. Why is that? Well, you ask the question, Kyle, to someone who's operating a mine, hey, how you holding it all together over there? And it's like, we're barely holding it all together. It is so unlikely that this mine is going to keep performing because there are so many variables. And so when you get to a point where life is the best it's been, and then you say, yes, I'd like a little bit more. Well, how do we do that? Well, we got to make a change. Are you sure you want to make a change? There is no right answer. The right answer might be, are you becoming the best version of yourself that you could be, such that when the volatility happens, you're able to make it through as best you can? That might be one right answer.
Making sure that you have yourself covered and you're at capacity to care for those around you, and to service your family, your friends, your customers to the best of your ability, and above all else, have your own needs taken care of where you're not reliant on somebody else or a system. Let's talk about one quick thing about gold ownership. When you own a little gold, you're a little bit outside of the system. That's a really nice thought. This is why gold is the ultimate alternative asset class, because there's no counterparty risk. Now, let me tie this all together, Charlie. Going back to Neil Howe's fourth turning, going back to how these cycles go over time, over hundreds of years. In the current cycle, there's a lot of voicing that it's not fair, because everybody has this baseline expectation standard of living. I talked about this in another episode.
Rightfully so, too, by the way.
Yeah, it's like we've all been lifted up. Now we're all at a higher standard of living. Now we can have the capacity to say, it's actually, instead of worrying about how I'm going to feed myself tonight, and the only way to do that is to be a farmer or to be a high society member of high society, now I can just push a button on my phone and there shows my food. So now that we can push a button and have our food show up, we have a lot of capacity to sit around and say, it's not actually fair for me. This creates, it's already happening. Wealth inequality, it's been happening for a long time. Now, given enough time, given enough people who will have this feeling of wealth inequality, rightfully so, right? Because of that human thing where we point to, you call it the ivory tower.
Anyone that has more than you is in the ivory tower.
Do you know where I'm going to wrap up and cut to the chase here? Do you see where I'm going with this?
Mm-hmm.
Given enough of that, now it's something like, I don't know the statistic, it's something like most millennials prefer socialism or something like that.
Yeah.
That may not be entirely accurate, but it's something similar to like that. I've read about it. So now we have a whole new generation of people with the it's not fair context, again, rightfully so. Now the cycles might be repeating. Now everything that we have gets torn down. Now we're going back into the weak men create bad times cycle. And
we're in the bad time cycle.
The cycle repeats.
Yeah, no, we're in the bad time cycle. We're getting the end of the bad time cycle apparently will be in like 2030. At the end of the gold bull run too, by the way, that you spoke to earlier.
So that was a whole lot of dialogue there, Charlie.
Kyle, wrap us up. Let's get the heck out of here. Get us going with a closing statement. Let everyone know how grateful we are for them to join us on this ride. And thank you for your patience, everyone, as we kind of drift through the conversation again.
Maybe this conversation piqued some kind of curiosity for you. Maybe you found it just plain like, what the hell are these guys talking about over here? In either scenario, we really appreciate you being here. Charlie, of course, we're going to pitch our standard offer. If you're interested in precious metals, check out bullionstandard.com/pro. You could have the opportunity to buy or sell or trade precious metals in unlimited quantities at market maker wholesale pricing. So, ladies and gentlemen, thank you for joining us on another episode of the Bullion Standard Podcast. I'd like to reiterate the standard offer. If you found this episode helpful or useful, we'd sincerely appreciate it if you would like, share, or subscribe, Charlie. Remember, every ounce matters, and so does every insight. Remember to stay informed, stay committed to growth, and hold your bullion standard very high.